Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, welcome back. We are sitting here on November 1st, Friday recording of the Energy Desk. How's it going?
Good. Survived Halloween. We made it back for a Friday. Good to be here. Alex, this week I'd like to start, if you don't mind, on the product side in the oil market. We've talked plenty about the geopolitical risks, and I'm sure we'll end there today. But let's take a look at some refining complexes that both you and I have covered in Daily Market Update, Energy Intel reports, but let's do an update, and let's start with this side of the world and our neighbor to the south, the Dos Bocas refinery in Mexico. For listeners, Dos Bocas is an addition to an existing facility. You think it like northern Yucatan Peninsula-ish area, and it has been planned for some time, as refineries do. They take quite some time to go from inception of idea to online. Give us an update on what's happening with the Dos Bocas refinery.
Yeah, so Dos Bocas, also sometimes referred to as Olmeca. This one was an AMLO project, so previous presidential administration for Mexico. And it's a notorious one a little bit when you're looking at new refineries where they are, throwing out their timeline to operation. And I think originally they were looking at middle of 2023, end of 2023, and then it keeps getting pushed back. Happened a few more times again in 2024, but we're finally starting to see the refinery start to process a little bit more crude. This two weeks ago or so, the new Mexican president, Claudia Sheinbaum, she said in her press conference that Dos Bocas is running at 80% capacity. It's 340,000 barrels per day for reference. And that's unconfirmed to date. It's really the first time that she's really given an indication, a quantified indication. The last report that we have for August says that it was still running at about 80,000 barrels per day. So pretty far off that 80% mark. But I think there's a few things to talk about there.
I'll interrupt you for a second. Just why should one care about the Dos Bocas refinery?
Yeah, that's a good question.
For listeners, the flow of crude and products between Mexico and the U.S. Historically, the U.S. imports Mexican crude or Mayan crude, refines it, and turns right back around and sends a bunch of products to Mexico. So with that, I give it back to you, Alex, and add some color to that statement.
Yeah, so the grade that the U.S. tends to import from Mexico is this Maya grade. So it's a little bit heavier, preferred slate for the U.S. And typically, as you said, exports to the U.S., sent back as products. One of the things that we are seeing with the crude imports from Mexico is that those hit back-to-back monthly or seasonal lows in July and August. July, we had 517,000 barrels per day. August, we had 572,000 barrels per day. For reference, I can pull up the historical numbers there, and we're looking at...
So those are crude imports.
Correct.
So into the U.S. bringing in this Mayan crude.
Exactly. And so when we look at the same months last year, we're looking at July, 948,000, and August 867,000. So the crude imports from Mexico are coming off. And I think the interesting question when we're dissecting this a little bit further is how much of that is actually from the refinery startup procedures and Dos Bocas bringing in some of that Maya grade. How much of it is due to production declines, which has been a bigger issue for Pemex in recent history. I don't know. Do you have any thoughts on that?
The Mexican crude declines, that was certainly a topic almost every year from, call it 2010 to 2017. Many places in the world, Mexico saw a nice bump in crude production in 2022 in a much higher price environment. I don't think there's any question that the Mexican crude producing capacity is limited with a 6 handle or even a 7 handle at the front of the TI curve, or even maybe a high 7s, low 8s at the front of a Brent curve, thinking global pricing. However, Scheinbaum has also made comments leading up to her taking over that there will be every effort made to stabilize Mexican crude production. Now, at some price, the setting money on fire to have a moral victory of holding crude production flat, I doubt will be a decision that she would stick to. Certainly seems to be driven more by her basis in economic theory than anything. I would expect that she is more a pragmatic spender of Mexican dollars than maybe an idealist that is trying to stick to a thesis. I think the interesting thing, and hear your comment on the flow of products, is whether this will translate to any shift in the product that we're sending to them. Because at the big read through, and really even stated at times, it's this almost deglobalization effort. The Mexicans saying, hey, we need to build a new refinery and get off the sauce of being so reliant on the US.
Right.
And many countries around the world taking similar efforts. So I'll kind of pause there. And what are you seeing with product flows?
Yeah. So this is, I think, one of the more interesting points when you look at the dialogue saying, so looking at Pemex saying self-sufficiency for fuel, as you just mentioned. So getting off of import reliance for the US. And in looking at August commentary for this, he was saying that they are getting close to that self-sufficiency mark. Yet, when we look at the latest data that was just produced yesterday, we're looking at U.S. product exports to Mexico, so far relatively unaffected. We have total products at 1.21 million barrels per day. We have gasoline at just under 500,000 barrels per day, which is the third highest for August since 2005. And distillate is 273,000 barrels per day, which is the lowest August since 2018, but not really that far off of historical norms. It's coming off a little bit in recent months. So I think the distillate is an interesting one to watch, but when you're looking at total product suite, you're not really seeing a whole lot of an impact. And I don't know, I guess one of the questions that I have for you within this kind of dynamic is you have Canada starting up that TMX pipeline in May. We expected that to have some kind of impact. Hasn't really shown to be super material yet, but I think there is a little bit of a relationship between North and South that could maybe have some points from you.
Take that, NAFTA. They'll close the doors and Canada will open a door. I'm going to pause for a minute before going to any thoughts on TMX and stay with what you just shared in terms of the flow of product. Just logically, if we are taking less of their crude, would mean that they are probably keeping it home. And whether Scheinbaum's comments about the new capacity at Dos Bocas truly running at 80% are a promise of what's to come or a restating of what has been. Less crude flowing here would logically lead one to believe that, yes, this refinery is up and running and processing mine crude and turning it into products. And then if we are not sending them any less than we have historically, one of, I guess, maybe three things is happening. Either A, they're building up reserves and is a form of self-reliance. Certainly when you have spare product in storage, whatever disruptions or shocks that may occur in the global markets, you're more insulated. B, demand is growing significantly. B, two, I think I said one, so I should stick with my theme. We'll go numbers. Number two, demand is growing. Number three, you have opened up through lower prices domestically more consumption, and yeah, it's along the same lines of demand is growing, but it's not the supply chasing the demand that it just couldn't serve. The third would be the demand was latent in there, it just couldn't be found at a certain price level, which would be scarcer products. Right. So I think it'll be interesting maybe in a subsequent one if whatever we can dig up in terms of prices at the pump, if you will. In Mexico, I imagine that's not as clean as a nice US based website that practically tell you how much gas it at every Love's and Bucky's and Sinclair all over the country. But I'm sure there's something out there. Yeah, agreed. I don't have a whole lot to add, honestly. Good for Asia. You've got access to some Canadian crude. And in theory, if that Canadian crude that was flowing to the Gulf Coast to get out doesn't need to come that way, you open up some dock space for U.S. barrel. U.S. exports are essentially unchanged. It's just maybe more of a barrel that's actually produced in the U.S. that's getting on the water in the Gulf Coast rather than a Canadian barrel that was once crowding out the U.S. producer. Unquestionably, there is more export capacity from North America. That's what TMX created. And as you said, so far, pricing impacts slim to none. Telegraphed, everybody knows where we're trading. There's been no significant change in diffs necessarily. And now Canadian diffs are better than they were, say, a few months ago, simply because you had a bunch of producers ramping up before TMX was really ready to go. Right. So barrels saying, oh no, where do I go now?
Yeah.
Can we move on to another refinery?
Let's do it.
Let's go to the other side of the world. We'll jump the Atlantic and go over to the continent of Africa and the Dangote. I hope I'm saying that. That's the way I've always said it. Okay, thanks. Confirmed. Dangote refinery. Think of this a lot like the Vogtle nuclear reactor. Planned and under construction forever. And one man's dream in the case of the Vogtle nuclear reactor. Southern Company's now retired CEO Tom Fanning, mic drop, said, I'm out. I got my nuclear plant done. So Mr. Dangote finally got his refinery done. It's been working for a decade. So not often will you find anywhere in the world where there is a single individual, and not that he financed it 100% out of his own piggy bank, I'm sure. However, one man's vision has come to fruition. And this key refinery is in a part of the world with great access to European markets. And at home has, in theory, plenty of available crude supply to fill it. And with that, what say you about the progress of the Dangote refinery and any interesting nuggets on its path to being fully operational?
Yeah, so it's a little bit of that self-sufficiency that we just mentioned for Mexico, where they want to get off their reliance for refined product imports. And 650,000 barrel per day capacity, this Nigeria Dangote refinery, and been a relatively slow startup process for that. But now we're getting up to indications that are saying in October and November, they're going to be processing somewhere in the order of 400,000 barrels per day. And it's getting up to speed there. And other commentary from the facility and the facility's managers is that they are producing enough petrol, gasoline to meet domestic demand. And so one of the things that I'm looking at for this is, as you mentioned, impacts for European markets. One of the questions that I think would be interesting to discuss is, what is this operational refinery? What does it do for Nigeria's demand for refined products from, say, Europe?
Yeah, like you said, it's exactly the same storyline. Wait, why are we doing this? Why would we export our crude somewhere else and pay these premiums to get product back? Mm-hmm. This just doesn't make any sense. And there's Mr. Dangote's vision defined succinctly. One of the interesting hiccups in the process so far has been getting what I'll call the Union of Nigerian Producers to deliver domestic production to the refinery. In fact, the Dangote refinery has been forced to import quite a few U.S. barrels of oil to process and turn into product. Now, it still prevents the Nigerian populace from having to pay for expensive European product imports. And at some point, that, I guess, pathway to having the Nigerian producers and the Dangote refinery truly work together for the betterment of the Nigerian population will have to occur. And right now, there's a stalemate. And pure economic theory, you can't blame the Nigerian producer. You're asking me to sell you this crude at a discount to somewhere else I can sell it in the world.
Right.
so that you can produce lower priced product. And the refinery has asked the national government to step in and intervene and enforce the producers to sell to them at really what would be defined a below market price. And I'm sorry, that sounds like socialism, certainly not capitalism. And eventually, I imagine there will be a meeting in the middle. The question you asked, I danced around a little bit. What does this mean for Europe? Yeah, you've lost a buyer in theory. I think the bigger question for Europe, and goes far beyond the small little European refining complex, is what's happening to European demand? And really a bigger question of, do the European people still want to live in Europe? 10 years from now, it'll be interesting to look back and say, what is the population of this country or that country and the European Union as a whole?
Yeah.
So sorry, a little philosophical there. I'm not going to speculate at all on European energy markets without saying, I don't know. It feels like a mass exodus.
It seems to be that point, and we don't have to really get into the weeds there, but there's definitely some stuff that we can talk about this week if we want. But for listeners, if we don't get to it, go to the research archive because we have some posts on that this week. Staying on the refinery conversation, though, I think when we look at, we have Dos Bocas, we have Dangote, you have China, who just started the first of its 2 units that are going to make total capacity 400,000 barrels per day in the Yulong petrochemical refinery. Then there's a host of other refineries in the Middle East and Kuwait and Oman and Saudi Arabia reaching full operational capacity this year. One of the things that I think needs to be a little bit more clear is, what does this do for the U.S. exporter? What does this mean for, say, Asian demand for U.S. crude products, et cetera? And maybe some dynamics that people can think about.
Yeah. So before covering the Middle Eastern projects, if you just go back and add together, and I'm sure Alex will probably have this in the show notes as a nice little simple bar chart, but Dos Bocas, Dangote, and the Yulong facility in China, you're a little under 1.5 million barrels a day. That's a significant number. And then look to the Middle East and you got a similar number. So there's a nice fun with facts number. How does an additional 3 million barrels of refining capacity around the world impact markets? When you look at stated global demand of somewhere north of 100 million barrels a day, 102, 104, pick your quarter, pick your source, it feels rather small. However, it's the marginal unit of demand or supply, depending on the environment, that sets the price. And so 3 million is not significant when you have things like 2022 happening, and there's a global BTU crisis. Had there been another 3 million barrels a day of refining capacity at the time, because recall, it was not anything other than a panic about having access to any form of a BTU that created that. It was actually European power markets which set things off, and everything followed. Crack spreads hit all-time highs. And so oil was just along for the ride. Oil trading $100 a barrel was really European power trading 1,000 euros a megawatt hour. Right. And then European gas trading $100 MMBTU, and products trading at, 2x the price of the refining input in some places in the world. I think this is the right move. Before we got on the podcast, my joke, and play the Jackie DeShannon song in your head. What the world needs now. Yes, I can't sing. Stick the word energy in front of world and stick the word more refineries at the end of the chorus. And this is the right move. We should build more. And our strategy deck this week is somewhat of a quip that our clients received. There's the idea of, what if in the US you built a couple million barrels a day of refining in the heartland, stuck it right at the intersections of I-35 and I-70, somewhere around Kansas City. We'll say, well, why wouldn't you put it on the Gulf Coast? And I actually had a client say just that. Wouldn't it be better on the Gulf Coast? In theory, it's all fine and good. More exports, more refining, as long as there aren't any hurricanes that come in and decimate those complexes. And I want to believe a hurricane cannot do any significant damage in Kansas City. However, there are some people in the mountains of North Carolina that said, I don't know. Careful with your bet. This is what we need. It's a great thing. And then if we add this refining complex, and this is next topic we'll go to here, you're certainly going to need more supply. We know there is plenty of supply out there. The U.S. Crude producing community has been treading water, we'll say, for almost a year now. We'll cover the latest data point in a bit. OPEC has been policing the market and showing restraint, at least most members. UAE, not so much. Iraq, there's always trouble with the Kurds. The Saudis really carrying the weight. And then you've got a friend down in the northern part of South America that has found the ability to produce some more oil. So Guyana, you and I, again, have also both covered that in several intel reports and daily reports. What's the latest from Guyana?
Yeah, so as we discussed a few episodes ago, maybe, we talked about the maintenance season that Exxon has documented ahead of time, but they had a maintenance season to connect the Liza gas pipeline to the floating production storage and offloading vessels in the Liza field of the Stabroek Block, which is the Exxon Consortium's offshore block where they're producing all this crude. And we had production take a hit during a few weeks in late July, early August. But as we discussed, that was trending higher for that month's production data. And as we look at the latest numbers for September, we see that daily average output from Guyana reached a new high of 659,000 barrels per day. And that's roughly 15,000 barrels per day above the previous high set in June. And I guess there's one piece that adds on to this that would change the near-term picture before I cover the long-term, is that Exxon's country head early in October said that they plan to increase output from their Unity FPSO from 252,000 barrels per day to 270,000 barrels per day. And really the timeline for that is really constrained to when they get the risk assessments and environmental assessments done. So could be imminent, could be a little bit longer, not very clear. The other side that I think people should pay attention to is that they have another project, Yellowtail, which is 250,000 barrels per day, that is on track for second half of 25 production start. And everything that I've been reading there seems that is definitely in order, and that'll bring production, including the 17,000 that they're about to add from Unity, over 10,000 barrels per day-ish by end of 25 is the target. So definitely
that's a really interesting, yeah. Put that in some context, right? So you don't have to go too far back in your time machine to find production in Guyana at about 250,000 barrels a day.
Mm-hmm. So you don't have to go as far to get them at 0 barrels per day. 2019.
True. When you put that in the context of the refinery additions we covered earlier, and knowing that there is still more behind the 900,000 barrels a day that Alex just pointed out, there's been plenty of headlines that would read that Guyana's production will ultimately get to 1.2 million barrels per day. So you are finding the supply. There's one place where it's coming. I think that the jury is still out on OPEC and anything from what happens in December when they're supposedly going to bring barrels back to what happens between now and then. And are there disruptions as a result of the still waging Iran-Israel conflict? But then there's the U.S. Can the U.S. add 500,000 barrels a day over a couple-year period between the U.S. and Guyana? Could we, in theory, satisfy all of the world's incremental demand? I would say it's a definitive yes. Now, with the U.S., there's the question mark of how do we get it to the rest of the world? Yeah, a good topic for another podcast. But we are, in some ways, export constrained. There's not another million barrels a day of dock space just sitting around with an empty tank, sad, lonely line wrapped around one of those giant cleats, not tied up to a big oil tanker. But we can. There is enough supply available between North America and Guyana, and that's leaving out a higher price environment that could stimulate some growth from Brazil or Mexico. We know we saw it in 22. So the supply is there, and are we going to price to get it? Right now with the front of the TI curve or the front Cal strip languishing sub 70, it certainly doesn't seem like the gas pedal is going to get stepped on. Things like Guyanese production increasing, that ship sails many years in the past. Mm-hmm. Offshore production of any kind, once it's sanctioned, not like ship has or train has left the station and there's no stopping it. The dynamic U.S. shale, Saudi, Middle Eastern production on off, I think that's the big question mark for the market right now.
Right. And I think we had a note this week that you talked about on the daily with the latest monthly production data from the EIA. And I think there's some related points that are pretty important to discuss with the SPR. And so I think that'd be maybe a good opportunity to dive into those.
Start with U.S. production. The print for the month of August, 13.4 million barrels per day. That's a new league record. For 11 straight months, we had been within, I would have to go back and double check, but I'm pretty sure it's 125,000 barrels a day of 13.2. And really most of the data points at slightly lower than 100,000 delta from that point. So very flat production. It's been troubling for us to reconcile with some of the quarterly reports for big oil producers. And lo and behold, we finally get a monthly increase. It would stand to reason, in our opinion, to see more small sequential increases reported in the months ahead. And in some ways, is this actually a true up? Was production in June or July, or even back to the spring, actually higher than what was reported, and we're just now starting to bleed them into the monthly data? Possible. Admittedly, maybe a conspiracy theory there. Stare at these numbers long enough and these monthly releases, and you'll come up with plenty of your own. I think the interesting thing, though, is that it's growing. The report shows sequential growth in August, and while today's price has nothing to do with what happened in August, is there a read-through? Do people go, oh no, production's going up now. What if it keeps going up further? I must price to ensure that it doesn't. More to come. For us, it was a long time in the making. Surprised it took this long to see a new league record.
Right.
And then I think the other one you asked about was SPR.
Yeah. So I think just lay a little bit of the groundwork there. We're talking about this week on the daily, looking at inventory data, and now we're looking at weekly data points. And so the point that we discussed earlier this week that I thought was a good point was that the SPR is essentially saving U.S. commercial stockpiles from a certain thing. And I think that is where I'll let you just take it off.
So I'm going to correct myself. Anybody that read that daily report, my statement at the time was, were it not for the SPR builds this year, there have been 43 weeks so far in 2024 that have been reported on by the DOE and its weekly stock data. That were it not for those takes by the SPR, that U.S. crude inventory would be at the highest level since 2009, excluding 2020. That is close to true, but not quite. There is actually 1 year in there, 2016, that would have been higher. The second highest crude stocks, excluding 2020, which if you need the explanation on why we would exclude 2020, please give us a call, shoot us an email. I think it's probably self-explanatory. And it's an interesting topic. If the SPR is and there's still plenty of room. SPR in the latest report has 386 million barrels stored. There's another 300 million barrels or so. And before anybody starts going, what are we going to do now? So certainly there is a relief valve for increased U.S. production. Now, it puts some interesting political dynamics at play. Current administration has said we're bid in the low 70s and patted themselves on the back for what they sold and then what they've bought back. A little bit of fudging numbers in our opinion. But it's an interesting shift, even on a year-over-year basis. I think lost in the fray is it's really seen as this 2022 dynamic. Prices were roofing and we were taking all of this crude out of the SPR to help the average consumer at the pump. Those draws continued into 2023. in a much lower price environment, essentially in the exact same price environment we've had this year. So in 2023, the cumulative 52 weeks of reporting showed an 18 million barrel draw in SPR stocks. And this year we've put in 31. So it's a massive year over year shift. So what would the domestic market feel like if we weren't 52 million barrels tighter simply because year over year because of that change in the SPR? Jury's out on that one too. I would say that let's see what happens next Tuesday and then the weeks after, as we unfortunately probably go about fighting over who is elected. But it'll be an interesting tool in the early days of a new administration. How will it be utilized? How will it be utilized in respect to the relationship with the Saudis? How does it utilized along a still consistent narrative of climate change and whether we should be using oil and refined products at all? It's for 2 decades, the SPR was just this sleepy giant that very rarely had any meaningful impact in the market. And now it feels as if it is as politicized as really any area of energy infrastructure and will be for the foreseeable future.
Yeah, I think maybe it'd be helpful for listeners to break down how the Strategic Petroleum Reserve would come into play with conversations with, say, the Saudis, just from a high level of maybe some things to think about.
Yeah, and thanks. Last week I stepped in and said, hey, you're acronyming them to death. So thanks for clarifying SPR. So how could it be used? If the new administration said, hey, it's really important to get in early, build a relationship with the Saudis so that we don't have a U.S. shale versus Saudi price war, then, okay, I'll tell you what, you bring some barrels back and we will step up our SPR builds. Everybody wins. You get some incremental market share because the net exchange, we would likely bring in a foreign barrel to put in the SPR because we want a heavier slate, like Alex mentioned earlier with the Mexican barrels, and we'll send the light stuff out to somebody else in the world, but working in that fashion. Or alternatively, if it is game on and nothing can be done, it's all right, if you're going to flood the market with crude, let's not take it until prices fall incredibly low. Incredibly, that's a subjective statement. Mid-50s, low 50s. If I'm the new U.S. president and there's nothing that prevents the existing administration from putting the screws to whoever's incoming, sorry, hinting at what might come, but really muddy the water for the new administration. Take action that has prices fall, stop the builds. And then a new administration having a very difficult time making the statement that, look, how great I am. Look what I did for you consumers with prices at the pump if they're already low. Essentially, they would have kind of only one direction to go, higher, and then you get blamed for it. I don't know. I could go on and on. I think the simple statement of fact, 2024, let's see, what's the average weekly build? The average weekly build, 731,000 barrels per week. Not a huge number, 100,000 barrels a day or so. In the past couple of months, that's jumped up to 880,000 barrels per week. And the range for the most part is pretty tight week to week. There's not this incredibly wide distribution where you're putting in 2 million one week and a couple 100,000 another week. It's pretty consistent. I think that the thing to watch for, and the really interesting thing is, does that rate of change double or does that go to zero? Those are the actions that would meaningfully change pricing dynamics at the front of the TI curve.
Right. Yeah, and it seems like right now also SPR purchases are limited by the funding pool that has been depleted since offloading that 180,000 barrels per day in 2022. And so those funds have been repurposed for other projects or legislation. And so I think that's also something that people have to reconcile, is how they're going to continue. But I think
that's easy. You just print more money.
Yeah, that's an option. That's an option. I think that is a kind of a nice point to maybe get off of the crude stuff, at least for a moment. And I want to hear a little bit more about what's going on in natural gas markets. We have some weather things to consider. We have cash starting off November in an interesting place. And so why don't you take that and run with it?
Gas market summarized very briefly. Record-setting warmth, spot prices in early November trading sub $1.50 at the hub, and the market shell-shocked from what is in the very, very early stages of winter looking like another blowtorch winter. So for some context on the weather, since October 1st and through the end of the 15-day forecast, which now conveniently lands on a nice round number of November 15th or the first half of November, population-weighted heating degree days are going to be about 150 below normal. That's good for a loss of at least 200 BCF of demand. Now, one might say, yeah, but CDs have been above normal, so you have to reduce that minus 150 delta. I don't know, I'm happy to debate that with anyone, but the point on the CDDs, I think, is a little bit in error in that half of the plus 40 on CDDs was from the second half of October, and warmth in places like New York, Philly, Chicago, where it's debatable whether that truly led to air conditioners being turned on or kept on, I should say. Yeah. So it is a significant amount of lost demand. Cash is still very weak. A lot of that is on a given day can be from elevated wind generation. There have been 3 periods in just the past few weeks where the collective wind output from MISO, ERCOT, and SPP, which we've talked about, and yes, I'm sticking with the acronyms this time to stay brief, the combined output climbed to 65 gigawatts on a day. That is as high as it can get, and we've done it 3 times in the past couple of weeks. So there's some weight. Mother Nature has said no demand, and she's come back in with her cousin, the wind, and said, oh yeah, and here's some extra demand destruction.
Yeah.
And I think really everything is lined up perfectly for bears. On an underlying basis, we're still undersupplied, or I should say underlying. On a weather-adjusted basis, we're still undersupplied. Some of the recent EIA storage numbers are a little bit muddy on that topic, but in general, we are tracking, from what is currently about 100 BCF storage surplus. If weather were normal, we could find ourselves with as much as a 600 to 800 BCF year-over-year deficit by the end of March. But weather may not be normal. So with that, you put out some thoughts, and I think this is a good place to conclude comments on natural gas this week with what's going on in spec positioning in the domestic natural gas market.
Yeah, so the specs for natural gas has been an interesting one to watch in the last 3 weeks of commitment of traders data from, as you've mentioned previously, the CFTC releases this every week for trades through Tuesday, reported on Friday. And this is talking about last week's data since it has not been updated yet, but we have specs at the 11th percentile 10-year distribution for net short. And so where that kind of splits, we're looking at 83rd percentile shorts at basically what I convert to over 3 TCF versus longs, you're at 19th percentile on that 10-year distribution and what I convert to 1.75. And so you're not at the point where, say, Brent was a few weeks ago, looking at October 1st before the Iranian missile barrage on Israel, but you're still getting into that top 2 deciles to say, okay, this could be a risk if weather surprises or any of these other surprise variables create a catalyst through spec positioning for adjusting price action. Before I go on to maybe some other stuff in there, do you have anything to add to that?
No, I think it's a great recap. It's incredibly warm. The specs are very short. So could it get warmer? Could we get shorter? Yeah, but by how much? And then conversely, what if it were normal? What would that do to those spec shorts? It's not that they necessarily have changed their view, but do they get out of the way to look for a chance to reload? There can be significant rallies when spec positioning is so lopsided.
Right. And we can go on for a whole lot of the other CFTC products that we're watching. The one that I will mention today is that looking back at the crude side of specs that I think listeners might want to pay attention to, as we discussed a little bit last week, you have WTI specs at their lowest on record. So that's just long positions, short positions combined for speculators. So longs, you're at 0th percentile, and short, still, relatively near median, 40th percentile, but just not too many people are in the market there. I'll leave it at that. But one of the things on the macro side that I wanted to discuss with you was we have, as you mentioned in the daily market update this week, another retaliatory strike, and the use of retaliatory is getting a little bit excessive at this point.
I don't know. We need a new word. Let's look at a new word. I don't know. Or put a number after it. Retaliation number 41. Exactly. This is not funny. This is awful for the people in the Middle East. This latest one is an interesting, and crude market slightly higher again this morning. This is Friday, November 1st at 12:30 Central Time, and the December contracts trying to make a move towards 70, not quite there. The latest headlines coming from an Axios report from unnamed sources with knowledge of what Israel knows. Sorry, there's some layers there. Is that Iran is planning a strike where they will use proxies in Iraq to do some damage somewhere in Israel or to Israel. And up to this point, I think maybe many have forgotten, with the long laundry list of retaliations, is there has been damage, there has been action taken on Iraqi soil in this war that's now waged over a little over a year. So it's bringing Iraq back into the forefront. And I think in some ways the market may be contemplating how vulnerable Iraq's oil infrastructure is relative to Iran's. Iran, for quite some time now, has prepared itself to defend some foe from somewhere. I think a bit more militarized, and certainly in some ways the good old US of A went in and significantly changed Iraq's militarization. Maybe I'm making a word up there instead of a new word for retaliation. And what went on there in the 90s. With Iraq being brought back into the fold, in theory, does it raise the risk again that there's going to be damage to oil infrastructure? Yes. Is it imminent? No. And I think really the important point you mentioned just before this, specs are on the sidelines. Why are you on the sideline? I don't know what's going to happen in the Middle East. I don't know what's going to happen in the U.S. election. I don't know if U.S. production is going to grow. I don't know when OPEC's bringing it back. There's plenty of unknowns. And that just means to me, you got a bunch of cats sitting around ready to pounce. There is an opportunity coming, and it's probably in a matter of a short few weeks. I wouldn't be surprised if we're talking about spec positioning from a different standpoint before Thanksgiving.
Well, I think the election plays quite a big role in Israel's response right now and how they're positioning. The commentary when I'm listening to VP JD Vance, potential VP, and President Trump is that it's a little bit, we have to let Israel handle Israel, and it gives the indication that they would give leeway for Israel to potentially start to expand that kind of retaliation again to infrastructure that has been limited so far. So they're really looking at the oil infrastructure for Iran. And while I think less likely, it does also raise, I think, the risk for even targeting some of their nuclear enrichment and some of these other spots that are so far being held off the table. So I think that the election plays quite a big role. And so we'll find out within the next week what that's going to be looking like.
I'm going to, as we conclude here today, issue a challenge to myself and to you. One of us should do a piece next week on how oil is traded right before Election Day and through inauguration, and say the past 4 to 5 administrations. There may be zero correlation to anything, but just curious with this time around, it certainly feeling as if there's more relevance.
Totally. Especially with the spec side, as we just mentioned. One last point that I'll throw in there for listeners, won't do a whole lot here, but on the kind of broader economic themes, we're going to have a lot of this in the research archives, so definitely go there. But one thing that I just wanted to note was that the U.S. manufacturing data came out, and so that ISM manufacturing survey and the S&P Global manufacturing survey for the U.S., both of those extended their streak of contractionary months. The ISM is 23 out of 24 months have been in sub 50 territory. So I think that's one indication for industrial demand to pay attention to. I think the more relevant industrial demand that I'm paying attention to across the globe is what's happening in Germany. And I think for interested readers, definitely go and look at that. And we'll put this in the chart deck, a few of the notable data series for people to see. But really, I think industrial demand in Germany and therefore in Europe is going to be taking quite a hit. You have VW this week saying that they're potentially going to close plants on German soil for the first time in the firm's history. Industrial capacity utilization in Germany is at its lowest since recessionary periods, 2009. So quite a few things to pay attention to on the industrial front. I won't dig into it here and extend the commentary, but definitely go look at the archive. And with that, I think we'll call it this week, and I'll see you next Friday.
Sounds good. Thanks, Alex. Good being with you.
Thanks for joining us at the Energy Desk. Again, this is a limited series, so if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.